There is a pattern that shows up in economic history with uncomfortable regularity. A new technology arrives. It generally changes things. It's not fake. It's not a scam. It works. People get excited. Then investors get excited. Then everybody gets excited. Money pours in faster than the technology can actually produce returns. Valuations detach from reality. And at some point, nobody knows exactly when, the gap between expectation and reality closes, painfully. It happened with railroads in the 19th century. It happened with radios in the 1920s. It happened with the internet in the late 1990s. Each time, the technology was real. Each time, the investment went far beyond what the technology could justify in the short term. The question worth asking right now, calmly, analytically, without either dismissing AI or uncritically celebrating it, is whether we are watching that pattern play out again. This video is not an argument that AI is useless or that the whole thing is a fraud. It's an attempt to understand the mechanics of what's actually happening with the money, because the money trail tells a more complicated story than most people realize. Before we can ask whether AI is a bubble, it helps to understand what a bubble actually is, because the word gets used loosely and that causes confusion. A bubble is not simply an asset that goes up in value quickly. It is a specific economic dynamic where the price of something becomes disconnected from its underlying productive value, driven not by what something actually earns, but by the expectation of what it might earn in the future, combined with the belief that someone else will pay more for it tomorrow than you paid today. The classic framework for understanding this comes from the economist Hyman Minsky, who spent his career studying financial instability. Minsky argued that bubbles follow a recognizable sequence. It starts with a genuine displacement, a real innovation or change that creates legitimate new opportunities. Then comes a boom, where early investors make real returns and attract more capital. Then euphoria, where the original logic gets stretched far beyond what the fundamentals can support. Then distress, as the gap between the price and reality starts to show. And finally, a crash, where the correction happens, sometimes slowly, sometimes very fast. The critical insight in Minsky's framework is that the underlying technology doesn't have to be fake for a bubble to form. The railroad bubble for the 1840s was built on a technology that generally transformed the world. The dotcom bubble was built on a technology, the internet, that did eventually reshape the global economy. The bubble wasn't about whether the technology worked, it was about how far ahead of reality the investment got. To understand where we might be with AI, it's worth revisiting what the dot-com era actually felt like from the inside, because in hindsight it looks obviously irrational, but at the time it didn't feel that way at all. In the late 1990s, the internet was generally transforming how people communicated, shopped, and consumed information. The underlying change was real. What happened around it was that capital started flowing not towards companies that had proven business models, but towards companies that had stories about what the internet might eventually make possible. The valuation of a company became less about what it earned and more about what it was imagined it could earn once the technology matured. Companies with no revenue, no profit, and sometimes no finished products were valued at billions of dollars. The justification was always that the market was so large and the technology so transformative that normal financial logic didn't apply. This was not entirely wrong. The market was large and the technology was transformative, but the timeline was wrong. The returns that investors were pricing in for the year 2002 actually arrived closer to 2012. The technology worked. The schedule didn't. What followed when the gap became undeniable was a correction that wiped out a significant portion of the capital that had been invested. Many companies that were genuine innovators did not survive long enough to see the returns that eventually materialized. The ones that did survive, Amazon, Google, went on to become some of the most valuable businesses in history. But the investors who funded the boom largely did not benefit from that. The timing destroyed them before the thesis proved correct. So where does artificial intelligence sit in Minsky's framework right now? The displacement is real and beyond serious dispute. AI systems are genuinely capable of things that were not possible 5 years ago. They are being used productively in software development, in legal research, in medical diagnosis, in customer service. The technology works. The question is what phase of the cycle we're in, and here the picture gets more complicated. The investment flowing into AI infrastructure right now is extraordinary by almost any historical measure. Technology companies are committed to spending that. When you add it all up, assumes AI will generate a level of economic return within the next 5 years that would require it to become one of the most rapidly adopted and monetized technologies in history, faster than the internet, faster than the mobile, faster than cloud computing. That may happen, but it is worth noting that every previous technology that eventually delivered transformative returns took longer than the investment cycle assumed. The internet did reshape the global economy, but not on the timeline that the capital flowing into it in 1999 was priced in. There is also a structural dynamic in the current AI investment cycle that is worth paying attention to. A significant portion of the revenue being generated within the AI ecosystem right now comes from large technology companies buying services from each other. One company's AI investment becomes another company's revenue, which gets reinvested into more AI infrastructure. This creates a loop that can look like a robust market growth from the outside, while a substantial portion of it is, in effect, the same money circulated within a closed loop. This doesn't mean the growth isn't real, but it does mean that the headline numbers overstate how much genuine external demand exists right now. There are real differences between the current AI investment cycle and the dotcom bubble, and it's worth being honest about them rather than forcing an imperfect analogy. The companies at the center of the current AI boom are not loss-making startups with no revenue. Microsoft, Google, Amazon generate enormous profits annually. They are not funding AI investment by burning through venture capital on a hope and a story. They have real businesses producing real cash that they are choosing to redirect toward AI infrastructure. That is a fundamentally different financial position from a company that existed only because investors kept writing checks. This matters because it means the floor is higher. If the returns on AI investment disappoint, these companies absorb the loss from a position of strength. The systemic risk of a correction is arguably lower than it was in 2000. However, and this is the part that gets less attention, the fact that the companies are financially strong does not tell you whether the valuations placed on an AI-specific asset are justified. A company can be generally profitable and still have a division or a subsidiary or an investment thesis that is priced well beyond what it can realistically deliver. The Japanese asset bubble of the late 1980s is instructive here. Japan had generally strong, profitable companies. Its manufacturing sector was the envy of the world. The bubble formed not because of the underlying businesses were fraudulent, but because the asset prices attached to those businesses, and particularly to property and financial assets connected to them, detached from the fundamentals could support. When the correction came, it came not because Japan's companies stopped being productive, but because the prices had simply got too far ahead. The strength of the underlying businesses and the rationality of the current valuation are two separate questions. Conflating them is one of the ways people talk themselves into staying in a position longer than they should. So, is AI a bubble? The honest answer is that nobody can tell you with certainty, and anyone who speaks with complete confidence in either direction is telling you more about their position than about the underlying reality. What the historical framework suggests is this: the technology is real. The long-term economic impact is likely to be significant, but the current investment cycle has characteristics that echo previous moments where capital got too far ahead of the returns that were actually available on the timeline being assumed. That doesn't mean a crash isn't coming tomorrow. Bubbles can persist for longer than almost anyone expects. The dot-com boom ran for years after serious analysts started raising concerns, and it doesn't mean that the companies building AI infrastructure will fail. Some of them will almost certainly emerge as the dominant economic actors of the next decade, just as Amazon and Google emerged from the wreckage of the dot-com era. What it does mean is that there is a difference between the long-term value of artificial intelligence as a technology and the current price being paid for exposure to it. Those two things can both be high, and one can still be too high relative to the other. The pattern that shows up in economic history is not that transformative technologies fail. It's that the investment cycle around them tends to price in the long term faster than the short term can deliver. And the people who get hurt are usually not the ones who are wrong about the technology. They're the ones who are wrong about the timing. That distinction is worth keeping in mind as this story continues to develop. At Macro Breakdown, we break down the economic forces shaping the world, clearly and without the noise. If this video gave you something to think about, subscribe and we'll keep covering the stories that matter. And if something here raised a question, drop it in the comments below.